Imagine waking up to a stock market that's defying gravity, soaring higher even as precious metals take a wild plunge. Sounds like a plot twist in a financial thriller, doesn't it? But in today's fast-paced markets, that's exactly what happened, leaving investors scratching their heads and eager to dive deeper into the drama. Let's unpack the latest twists and turns in global finance, where the FTSE 100 climbed despite gold rollercoaster ride, and uncover why this could signal bigger shifts ahead. Kicking off the day, the FTSE 100 index managed to gain another 0.5% during early trading sessions, showcasing some resilience amid broader European weakness. Meanwhile, the gold market turned into a veritable amusement park of ups and downs, with gold mining stocks mirroring the precious metals' volatile path from Tuesday onwards. These miners had just hit multi-year or even all-time highs the previous week, only to plummet dramatically. London's heavyweights in the sector, such as Fresnillo, Endeavour Mining, and the royalties-focused Wheaton Precious Metals, each tumbled between 9 and 12% on Tuesday. The Van Eck Gold Miners ETF, which tracks these trends, also dropped a sharp 9%, largely dragged down by major players like Barrick and Newmont. Even though gold prices rebounded modestly in the North American afternoon, investors seemed reluctant to jump back in right away. Endeavour slipped again on Wednesday, highlighting that cautious sentiment. Delving into the numbers, gold crashed to $4,080 per ounce on Tuesday, representing its most significant single-day drop in over a decade from the previous week's record peak exceeding $4,300. A partial rebound pushed it back above $4,100 per ounce later that day, but the overall vibe was one of hesitation. Market watchers attributed this to investors cashing in profits, and a temporary slowdown in aggressive buying from markets like India following the festive Diwali period. Fundamentally speaking, this pullback might actually be a healthy breather, a consolidation that was long overdue. Conditions had stretched to extremes, with the market showing signs of being vastly overbought. For instance, a weekly relative strength index, RSI, above 76 isn't exactly a green light for more purchases. Picture this, a $1,000 surge in just 6 weeks. That's pushing the envelope, no doubt. But here's where it gets controversial. While this gold rally has strong underpinnings that set it apart from past frenzies, skeptics wonder if we've truly seen the peak yet. After all, we've witnessed robust buying during dips, sending prices soaring about $150 from recent lows in a relatively short span. For newcomers to investing, think of RSI as a speedometer for market momentum. Anything too high suggests it might be time to pump the brakes. And this rally's foundations. They're built on durable factors like global economic uncertainties, not just fleeting hype. But that doesn't rule out more upside. Could this be the calm before another storm, or are we entering a prolonged slump? Readers, what's your take on gold future as a safe haven asset in uncertain times? Shifting gears to other standout performers, Barclays shares jumped 3% after the bank boosted its guidance and unveiled an additional £500 million share buyback program, even as its quarterly profits dipped slightly. The company is still aiming to return at least £10 billion in capital between 2024 and 2026, with its turnaround story looking solidly on track and investment banking showing more promise than earlier in the year. For those new to banking stocks, this buyback means the company is essentially buying its own shares to boost value for remaining investors, a move that can signal confidence in long-term prospects. Wrapping up the session, the FTSE 100 edged up about 23 points to close at 9,426.99, while Wall Street presented a mixed bag. Positive earnings reports from companies like 3M and Coca-Cola propelled the Dow Jones up 0.5% to a fresh record high. Tech stocks, however, told a different story, with the S&P 500 ending flat and the Nasdaq Composite slipping 0.2%. The big revelation from yesterday's earnings season. It hinted at a leadership shift in the market rally, moving from tech-dominated gains to a broader embrace of industrials. This diversification is a bullish sign, suggesting the economy and corporate profits might exceed expectations across various sectors. Think of it as the market broadening its horizons for a more sustainable growth story. On the inflation front, the UK surprised everyone by holding steady at 3.8% in September, falling short of the widely anticipated 4%. This opens the door for the Bank of England, BoE, to potentially cut interest rates sooner and more aggressively than previously priced in by markets. Core inflation dipped to 3.5%, and key services inflation remained at 4.7%, beating the expected 5%. Interest rate swaps reacted sharply, now factoring in an additional 2 full cuts by spring 2025, which drags sterling down to a one-week low after its prior uptick. For beginners, interest rate swaps are like bets on future rate changes. They reflect what traders expect the BoE to do next. The BoE itself believes September marked the peak for UK inflation, which could be a win for those hoping for rate relief. But, and this is the part most people miss, we should proceed with caution. Uncertainties surrounding the upcoming budget mean November is probably off the table for any moves, but December looks increasingly plausible. And this is where controversy brews. Is the BoE's optimism justified, or are we setting ourselves up for a bumpy ride if inflation surprises again? Could this steadying act as a double-edged sword, boosting growth but risking a resurgence in prices? I'd love to hear your thoughts. Do you think the BoE is playing it too safe, or is this the smart path forward for the UK economy? In the earnings spotlight, Netflix delivered decent results but saw its shares drop 6%. Revenues hit expectations, yet a tax dispute with Brazilian authorities slightly dented earnings. General Motors, on the other hand, soared 15% by scaling back its projected tariff impacts and raising its annual profit outlook to $12 billion to $13 billion from the previous $10 billion to $12.5 billion range. GE Aerospace lifted its forecasts as services revenue climbed 28%, pushing the stock to a new high. Coca-Cola reported 6% organic growth, surpassing forecasts and lifting shares 4%. Industrials like RTX and 3M also shone with robust figures. This widening of strong earnings across sectors strengthens the case for a more enduring market upswing, much like how a well-diversified portfolio weatherproofs against single-sector storms. By Neil Wilson, investor strategist at Saxo UK. What do you think about these market movements? Are you bullish on gold's long-term prospects, or do you see inflation surprises derailing the UK's recovery? Share your views in the comments. Let's debate the controversies and unpack what this all means for your investments.